Portfolio risk. 3 smart ways you can reduce it. Sometimes it takes a stock market drop to get investors thinking about how to better protect their downside. To arm yourself against a potential market downturn, you may want to re-examine your investment strategy through the lens of your current risk appetite and time horizon. Watch this video to learn some basics of risk management and find out tactics that sophisticated investors use to manage risk during turbulent times. Start today so you can craft a sound risk mitigation plan that might allow you to be prepared either financially or emotionally to tolerate a sharp decline in your portfolio. Welcome back, folks, to another edition of Sweetie Kiwi. How you doing today? I hope you are doing fantastic. I'm doing marvelous if you were to ask me. If you are doing as impeccable as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about 3 smart ways you can reduce your portfolio risk. Now, first thing you need to do is reassess. Before you even think about making any readjustments to your holdings, make sure your financial plan is up to date. So you need to either go to your Excel spreadsheets or have and talk to your financial planner or whatever tool or whatever expert you use to craft a financial plan. You want to make sure you go back to basics and make sure everything is updated. Here I'm talking about, does your portfolio mix still match your risk tolerance? Does your risk tolerance still match your goals? Because a spike in volatility can remind investors why it's often wise to take a more conservative stance the closer you get to retirement. What I'm saying here is that if you are in your 50s, the strategy you are using in terms of risk tolerance should be different from someone who is in his or her 30s or 20s, right? So the closer you get to retirement, you have to be very conservative in terms of your risk tolerance, which will impact your asset diversification. So when you get close to retirement, for example, you want to shift from stocks into bonds and other fixed income investments. For example, fixed income investments, I'm talking here about short-term bond funds, money market accounts, U.S. Treasury bills, those kind of investments. Indeed, those in or near retirement may want to keep enough cash on hand to cover 2 to 4 years worth of spending needs after accounting for other sources of income, including Social Security. So this degree of financial flexibility can help investors manage unforeseen expenses without having to liquidate stocks under less than ideal conditions. This is what happens if you have volatile assets in your portfolio and you are forced to sell. You may incur losses, and you may even incur, for some people, what's even worse, they have to pay taxes, but not the capital gains taxes, but being taxed at the normal rate, which is for some people 33% or 35% if you are in the high tax brackets. So on the flip side, and this is basically for people who are close to retirement, as I said before. On the flip side, if retirement is at a comfortable distance for you, say you are in your 20s or you're in your 30s, you should not be too spooked about swings in the market. I've always said this, you have sufficient time, so long as you stay invested, to wait out a downturn and capture the longer term gains the stock have historically delivered. A lot of folks are kind of scared when you have a little down movement, a little bear, a short-term bear market. Folks are really spooked and they start selling, and you don't want to do that. You want to sit tight. If you are in your 20s and 30s, the markets always come back. Sometimes it might take longer. It might take 5 years, 10 years, 20 years. But as long as you just sit tight and stay invested, you will be fine. So after reassessing, you want to rebalance. Let's talk about rebalancing. No. Rebalancing here is kind of important. This is the second thing you need to do to reduce portfolio risk. Your portfolio should match your appetite for risk. So if the recent stock market volatility made you jump ship, you may consider revisiting your allocation. The reason here is that you're kind of scared. If a small dip in the market scares you away, that means that you don't have the right asset allocation yet. So equally important, you want to make sure that your intended asset allocation matches your actual wants. If it doesn't, you want to consider rebalancing by selling overweight positions and buying underweight ones. So when you fail to rebalance as stock climb, your equity allocation can become an ever larger part of your portfolio. What I'm trying to say here is that rebalancing means that, let's say you want to have a portfolio that has stocks 50%, bonds 35%, and cash equivalent 15%. So 50 plus 35 plus 15, that's 100%. And what happens is that as the market goes through ups and downs, when the market experiences corrections and boom periods, you have to make sure that those percentages that you have laid out in your asset allocation plan remain intact or close to intact, or close to the ideal. In other words, if there is a movement in the portfolio, you want to make sure you still are at 50% for stocks, 35% for bonds, for fixed income securities, and 15% for cash and cash equivalents. That means that if your stock, if a stock goes up too much, if you have made a great profit in a particular stock portfolio, you may want to sell that. And then, so that's called overweight. And you want to buy underweight stocks that have dropped a lot. That way, you're constantly rebalancing your portfolio according to the kind of plan you have. And by doing that, you are able to reduce your portfolio risk over time, because you're not going to see the kind of a sharp drop or the sharp dips that you see sometimes in other people's portfolio. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We are still having a conversation right now around ways to reduce risk in your portfolio. And I'm giving you 3 steps, 3 easy steps that you can use today to position your portfolio in such a way that you are reducing risk. So first, I was just telling you that you need to reassess your goals. Number 2, you want to rebalance. And the third thing you need to do is you need to remain calm. Please, by all means, reassess and rebalance, but do not forget to stay calm while doing so. So trying to dump investments when the market is dropping is a great way to invert the old saying that about buying low and selling high. If the head for the exits feeling is familiar, you may be the kind of investor who would benefit from a more conservative portfolio as part of your long-term strategy, not as a response to a market upset. What I'm trying to say here is that you have to think about, if you're kind of scared at the very first movement at the very first downward movement in the market, you may be too leveraged. You may be over leveraged. In other words, your portfolio is too aggressive for the kind of risk tolerance format, the risk tolerance scheme you should be comfortable with. So you want to dial down your aggressiveness, your portfolio aggressiveness, quote unquote, and you want to switch more to the more conservative side of the risk spectrum. At the end of the day, though, staying invested to support your goals can help you avoid making decisions in the heat of the moment. So a lot of research, we have abundant literature out there that shows that even bad market timing beats sitting on the sidelines. So when you trying to get in and stay in, we have here, we're showing on the screen right now, we have a very good illustration from our friends at Schwab Center for Financial Research. And you can see here on the screen that they are actually showing you there are 4 hypothetical investors who invested $2,000 a year and where they would have ended up after 20 years. And we found this very illustrative of the whole notion of getting in and staying in. So we have the first investor. Perfect timing. This investor invested at market bottom each year, and that investor has reaped $176,679 again after 20 years. We have the second investor, ASAP. He or she invested on first trading day each year. That investor has gathered, if you will, has collected $163,918. Bad timing, investor category number C. So this investor invested at market top each year. Again, 142, $1,612. And here is a person who, in the fourth category of investors, have invested all cash. So we're talking here at 30-day treasury bills, and they've made 64,000, about 65 grand. Folks, do you see what we're seeing here? Obviously, I just want to say one thing: past performance is no guarantee of future results. And the second disclaimer, the second caveat here is that I'm not giving financial advice. Everybody's situation is different, and I would strongly advise you to contact a financial expert, or if you are a financial guru yourself, please take take today's talk as general information to shed light on an important topic such as portfolio risk management. Okay, so what we're seeing here is what we're seeing here, that you want to always get in it and stay in it. You want to stay in the market. Don't be scared about anything. Don't be scared about the temporary movement. You want to stay in. You can see the people, the three categories: A, B, C: perfect timing, ASAP, and bad timing. Even if you have the bad timing, you're still better off, as opposed to just putting all your cash in, all your money in a cash account or cash equivalent account. You're not making, your money should be working for you. Your money should be working for you while you're sleeping, while you're having fun, while you're eating, while you're taking care of business. Your money should be working for you. Now let's talk about things you can do to reduce your risk further, things you can do today. So moves you can make. So after reassessing your plan and rebalancing your portfolio, if you want to take an even more defensive stance, there are other minor adjustments you might make. Specifically, you could bump up your holdings of less risky asset classes and trim your long-term allocation to riskier ones. Let me give you a few examples here. Consider more cash, consumer staples, healthcare and utilities, gold, and treasuries. Cash, generally speaking, your upside with cash is limited, but it retains its value in the face of even the steepest market declines. And cash tends not to move in lockstep with changes in the future prices of other kinds of asset. So cash, if you think about it, is the ultimate defensive asset. It's a great way to hold an emergency fund. Even aggressive investors should consider keeping at least 5% of their portfolio in cash. Consumer staples, healthcare, and utilities. When the economy slows, companies that sell products most people need, regardless of the state of the economy — I'm thinking here about food, prescription drugs, and other household necessities — they tend to lose less value than those that produce non-essential products. So owning this and other so-called defensive stocks can be a good way to potentially capture at least some of the market's gains while remaining relatively protected from its bigger swings. As you probably have noticed lately, after the COVID, when the market dropped in March and April 2020, you saw that the impact, the downward impact, was kind of limited when it came to certain consumer staples companies, because people will still need to eat anyway in a crisis or in moments of joy. So this is really a great way to rebalance and to reduce risk in your portfolio. You can also track gold. The precious metal has a history of holding its value, even rising when other asset classes are under pressure. In fact, it was one of the few investments with positive returns during the worst days of the 2008-2009 financial crisis. Keep in mind, however, that while gold and other precious metals can shine when the market conditions are uncertain, their prices can be volatile. You can also consider treasuries. Those are backed by the full faith and credit of the United States government. So these treasuries are considered by experts the safest fixed income investments you can own. So short-term treasuries, which mature in a year or less, or intermediate-term treasuries, which mature in less than 10 years, can provide decent income with low risk. Longer-term treasuries may offer even more income, though their prices could take a hit if interest rates continue to rise. So I've just told you things you should consider more. Now let me just tell you things you should consider less. You should consider less corporate and high yield debt. Again, consider less means that you're trying to reduce the risk in your portfolio. So you should consider less corporate and high yield debts, emerging market stocks, small cap stocks, and tech stocks. Corporate and high yield debts. So the value of outstanding debt owed by business outside the financial sector has nearly doubled over the past decade to a record 9.8 trillion, according to research by McKinsey. Now, as companies capitalize on historically low interest rate, raising concerns of a potential bubble. So you want to really stay away from that market for now. You also have emerging market stocks. So slowing growth in developing countries has helped stoke some of the recent market turmoil. China, for example, is growing its economy at its slowest pace in more than a decade, with ongoing trade tensions threatening to make matters worse. Now, small cap stocks. Publicly traded companies with a market cap ranging from roughly 300 million to 2 billion tend to be more volatile than their large cap counterparts, particularly during a downturn, right? So this is something that you might want to stay away from, or at least reduce your exposure to them. What about tech stocks? Again, large cap technology stocks such as Apple, Alphabet, and Microsoft led the market to new heights over the past decades. But when markets turned volatile in late 2018, 2019, and even in 2020, these stocks fell fast. So again, this is something you have to pay attention to as you try to rebalance your portfolio and reduce your risk. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. Let's just quickly recap today's conversation. But before we do so, I want to say that there are ways to de-risk your portfolio, the right way and the wrong way. There are a lot of ways to dial back the risk in your portfolio. The idea here is to balance things correctly. The idea here is to embrace the options I've given you in appropriate amounts based on your long-term goals and based on your time horizon. Again, if you are in your 20s or 30s, you don't have the same risk management tactics as someone who is nearing retirement or in his or her early 50s. So, for example, taking a more aggressive tactical approach may be right for investors with the inclination, time, and skills to watch the market closely. So if you have an aggressive portfolio or strategy, you're fine. You can watch the market go up and down. You can watch CBS, you can watch CNBC, you can watch Bloomberg and be comfortable. You can read the Wall Street Journal, and if the market loses, if the S&P loses 500 points or 1,000 points a day, you're fine with that. But if you're not that kind of person, and very few investors are like that. So if, like most investors, you are focused on the long term, one of the best ways to play defense is to maintain an asset allocation that matches your time horizon and risk tolerance. So if you decide to add or trim exposure to certain asset classes, make sure you're going to do this in a clear manner, that you're doing this in response to your needs and goals, not because of short-term market gyrations. Those gyrations come and go. They are part of the financial market universe. They're part of the financial market ecosystem. Please, folks, markets go up and down. That's what markets do, right? So the goal here is to follow a strategy you can live with through the ups and downs. All right, folks, let's quickly recap today's conversation. So I was just talking to you about how to manage, how to reduce your portfolio risk. You can do this through three smart ways: reassess, rebalance, and most importantly, remain calm. And once you do this, there are moves you can take. You can consider more cash, consumer staples, healthcare and utilities, gold and treasuries, and you can consider less corporate and high yield debts, emerging market stocks, small cap stocks, and tech stocks. I will see you next time. But until then, remember, stay marvelous.